Ever wondered how a country keeps track of every rupee or dollar coming in and going out across its borders? Just like your bank statement shows money you earn and spend, nations also have a financial record. That record is called the balance of payments, and it works hand in hand with something every government guards like treasure: foreign reserves. Welcome back to the Learning Studio, where we make economics clear, visual, and exciting with whiteboard animations. Today's topic, part of our Global and Applied Economics series, will explain what the balance of payments is, what foreign reserves are, why both are vital for a country's economic stability. You can watch the full economics playlist linked below in the description. What is the balance of payments? The balance of payments, BOP, is a detailed record of all financial transactions between a country and the rest of the world during a specific time, usually a year. It's not about balancing exactly to zero, it's about tracking flows of money in two main categories. One, current account, records imports, exports, services, and money transfers. Example, if India exports software to the US, that's money coming in. If India imports oil from the Middle East, that's money going out. 2. Capital and financial account, records investments, loans, and ownership of assets. Example, a foreign company building a factory in India adds to inflows. An Indian company buying property abroad adds to outflows. When more money flows in than out, the country has a BOP surplus. When more flows out than in, there's a BOP deficit. What are foreign reserves? Foreign reserves are the stockpile of foreign currencies, gold, and special drawing rights, SDRs, held by a country's central bank. They act as a financial safety net. Example, if a country's currency is losing value, the central bank can use foreign reserves to buy its own currency in the forex market, supporting stability. Reserves are also used to pay for imports in times of crisis, repay international debt, maintain confidence among global investors. Why these matter in real life? Imagine a country that imports more than it exports for years. It runs a BOP deficit and spends foreign reserves to cover the gap. If reserves run too low, the country may face currency devaluation, struggle to pay for essential imports like fuel or food, need emergency loans from the IMF. Case study. In 1991, India's reserves fell so low they could barely cover 3 weeks of imports. The government had to pledge gold to the IMF and start major economic reforms. Famous quote, "A strong economy starts with a strong balance sheet," adapted from Warren Buffett. For a nation, that balance sheet is the balance of payments, and the emergency savings account is the foreign reserves. Why you should care. Understanding BOP and reserves helps you interpret why currencies rise or fall, why some countries boom while others face crises, how global trade impacts local prices. It's not just for economists, it's for anyone who wants to understand how the world's financial gears turn. Coming up next, in the next episode, we'll explore international trade, benefits, barriers, and agreements. So hit subscribe, tap the bell, and keep learning with our full economics playlist linked below. This is the Learning Studio, where economics meets clarity and creativity.